ARK Invest is in the midst of the worst downturn in its history. In the last year, ARK's flagship ETF has lost about 40% of its value, while the S&P 500 has gained nearly 25%. For ARK investors, this is a worrisome gap. The cause of this underperformance is ultimately linked to the macroeconomic environment. ARK Invest will continue to crash unless these issues are reversed or at least rectified. This video will explain what those variables are, as well as what Cathie Wood has to say about the ARK investment downturn. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. The Fed has completely failed to save America's economy on all fronts. Equities and consumer prices accelerated at all-time highs as Fed Chief Jerome Powell printed extravagant sums of money during the pandemic. The Federal Reserve is now acting in the exact opposite manner. They are reversing its prior decisions and will soon withdraw money from the economy, estimating that it will stop buying bonds by mid-March, also known as quantitative easing. From then, the Fed will start selling bonds and boosting interest rates to reduce its balance sheet. In layman's terms, the Fed started printing money in 2020 and 2021. In 2022, though, the Fed will use a vacuum to take back a considerable portion of it. In the short run, this will probably have a negative impact on the economy, which is already factored into present valuations. The reason for this is that the Fed sells bonds. Bond rates must rise. Increasing interest rates are an issue for creative companies because they need to borrow money on a regular basis to keep developing. Greater interest rates indicate that borrowing costs are higher, which is bad for innovative companies. Bond rates have lately risen, and investors expect them to continue to rise. As a result, ARK Invest-linked stocks continue to plummet week after week. So when will this turbulence end so that innovation can flourish? Inflation is at the heart of the solution. If the Fed continues to wreck the economy, it's very likely that the Fed would revert to quantitative easing, which is when the Fed buys bonds. On the other hand, if inflation rises to new highs, the Fed will have to either stick to its current strategy or become even more active in its withdrawal. In plain terms, if inflation decreases, the money printer will most likely come back on, benefiting ARK Invest. On the contrary, if it rises, the money shortage will persist. For a variety of reasons, Cathie believes the first scenario will occur. But first, I'd like to address their reasoning for why ARK is crashing the pricing of so many automated traders. The second scenario we discussed is that inflation will continue to rise. Many investors believe that algorithmic traders improve market efficiency, yet the opposite is actually true. During the early stages of the pandemic, algorithmic traders concentrated their effects on shorting firms that were losing money while simultaneously having a small capital cushion. These algorithms work in general, but not in all industries. GENOMIC stocks, for example, fulfilled those criteria and were significantly penalized as a result. Any rational person, on the other hand, would recognize that GENOMIC's businesses would have a role in the pandemic solution. Dislodged. After a month of declines, GENOMIC stocks are on the mend. Cathie believes that in the exact same situation, automated traders are punishing equities that are perceived as riskier and are rotating to value because to inflation fears and rising interest rates. High valuation multiples, minuscule earnings, diminishing sales, growth, and poor cash buffers are just a few of these traits. Zoom and Teladoc, for example, are the two stocks with the most conviction that follow these qualities. Both of these equities are on the verge of being completely destroyed, having lost nearly 70% of their value. Teladoc is our second largest position, and Zoom is the fourth largest position. Investors like these two stocks to tech companies during the dot-com bubble, but Cathie thinks they are totally wrong. She believes that the dot-com bubble was premature and that the dreams at that time were becoming real. Now, the dreams back then were quite transformative and led to the cloud and AI. As Cathie stated, we are living in the reality that the dream started. And this reality has companies like Teladoc and Zoom. Just to give you a sense of the contrast here, you know Teladoc has about $2 billion in sales? Its revenues have gone up fourfold since the beginning of the coronavirus, and we don't think that its revenues are going to go down anytime soon. What we're seeing in the market is a focus on year-on-year moments, and this is the last of the really tough comparisons. Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter of the quarter, they will report to be up to 19 to 20%. And that's probably the low point of its growth rate, we believe. Zoom's revenue growth is going to accelerate from there. We talked about the macroeconomic environment and how it's pushing ARK to invest in the crash. But when will the crash come to an end? The cool down arch will most certainly rebound significantly once inflation begins. Cathie feels that multiple indicators are pointing to a significant slowdown in inflation in the near future. Cathie's indicators aren't being covered by the traditional financial media, which effectively brainwashes investors into believing that inflation must continue to rise. The first signal is the cost of a used car. Economists and financial professionals have utilized the Manheim Used Vehicle Value Index as a tracker for used automobile prices. This index rose dramatically during the pandemic, but new data suggests that the bubble may be about to break. At its height, the index grew at a rate of about 60% a year, but prices have recently begun to rise at a rate of 1.2% per month. This is a significant shift, indicating that inflation may be more transient than people believe. Consumers have begun to establish their own secondhand vehicle inventories, and this inventory momentum can't last indefinitely. This, I believe, was the most fascinating aspect of the current economic situation. The used automobile index for high-end vehicles has begun screaming. On a year-over-year basis, the price of second-hand automobiles had grown at their high. There was a 60% increase in the CPI as a result of this. Well, there have been a few reports recently that imply the bubble was in used cars, which is extremely interesting. Used automobiles costs are currently declining by 4%. But they're still up 46%, and they're starting to decline. And what that tells us is that they'll keep falling, despite the fact that they've had a disproportionate effect on the CPI. In the used car market, there is now an inventory buildup. Cathie feels that normal inventories for secondhand autos are now 43 days. However, now they're 54 days old, so much better than normal. Their lows were in the area of a 20-day supply. Many people are now looking at the increase in used car costs, and they're probably considering selling that automobile they bought to avoid taking public transportation during Corona. If they observe prices falling, they will most likely move a little faster. Consumer sentiment is the second sign that Cathie is keeping an eye on. Although consumer prices are rapidly rising, this does not necessarily indicate a high level of consumer demand. Low supply, rather than high demand, is the primary source of inflation. Supply networks are unable to match current consumer demand, which is already beginning to decline. Retail units are only expanding at a 0.3% month-over-month rate, which is not keeping pace with a 0.77% month-over-month growth in consumer prices. This indicates that consumer spending power is not keeping pace with price rises. The Consumer Confidence Index in the University of Michigan, which is fast falling to a new low, exemplifies this mood nicely. Consumer mood has plummeted to levels last seen during the coronavirus outbreak in November and December. Now, that's a very important part of the time of the year for the consumer to be feeling unconfident because it's the biggest selling season of the year. As a result, we suspect there is an issue. We now have retail sales figures for November. We're at a 0-point deficit. They were up 0.3%, but what did real expenditure do when inflation was taken into account? That's nearly 3.5% on an annualized basis during a critical time of year. If you add in services to your retail sales, you'll notice that real consumption in total goods and services was unchanged. Again, this is a critical time of the year, and it was also a time when we anticipated a huge surge in service consumption as a result of the pent-up demand, but we were oblivious to it. So it is one clue that things isn't quite right out there. In addition to the used car bubble popping and consumer sentiment weakening, the US GDP is also pointing towards a massive buildup in inventory that gross domestic product, or GDP, measures, the total amount of goods and services sold in the country. The US GDP has been increasing recently, which sounds great on the surface. However, the entire GDP growth was from businesses purchasing new inventory that isn't even being used. Wholesale inventories and retail inventories are accounting for the entire GDP growth, which has serious implications. If businesses are building up their inventory that is not being sold, then prices will have to struggle. According to Cathie, in the third quarter of last year, real GDP was up 2.3%. It was a big disappointment relative to expectations, but what the headlines did not feature are still not featuring is that practically all of that went into inventories. It wasn't sold real final sales. So even in the third quarter now, we're starting to think at a time when everyone was talking about supply chain problems. And she thinks what we're beginning to see is the consumer getting quite upset that the prices of necessities were escalating and destroying purchasing power. Now, what she gets even more interesting is watching that inventory number. In the fourth quarter, wholesale inventories were up to 2.5%. Now that's month to month. Remember, this is when supply chains were causing all kinds of shortages. Then again, in November, wholesale inventories were up 1.2%. Again, double-digit rate annualized. Part of the reason is consumption was not playing ball. And then you look at the retail inventories in November, up 2% again. That's month-to-month annually. To quote Cathie Wood, "So there is something I don't believe the headlines have adequately represented. It's possible that you'll be startled as well. The buying managers are the last significant metric that Cathie is keeping an eye on. The Purchasing Managers Index, or PMI for short, is a study conducted by the country's top purchasing and supply executives." According to Cathie, this index recently declined by almost 4% month over month, which is showing that the purchasing power of consumers has rapidly declined. And the other December statistics that we got besides autos are the PMOs, the total PMI and PMI for services. Both of them came down, and prices paid in the Purchasing Managers Index came down a lot more than people were expecting. Cathie thinks the expectation was somewhere around the high 70s or 80s. This is a diffusion index. Instead, it was 62. Now, that still means prices are up because they're still above 50, but coming down pretty fast. We've talked about many indicators showing that inflation could slow down in the future. If those indicators are overcome by other factors, like the continued supply shortage, ARKs, ETFs could easily crash even more. However, Cathie definitely has a lot on the line, and she clearly has a lot of conviction in ARK's recovery. She actually recently disclosed that over half of her IRA is currently in ARKs. As Cathie previously stated, the innovation that has been evolving and was accelerated coming out of the COVID situation is unstoppable, and the convergence between and among the 14 different technologies that we are researching is underway now, and is causing and will continue to cause explosive growth. Really, the likes of which we haven't seen in our lifetimes. So there you have it, why ARK Invest keeps crashing and what will be necessary for it to rebound. Do you believe Cathie is correct in her short-term forecast? Are you planning to sell, hold, or purchase ARKs? Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video!